Yeah, it's a really interesting point, and this is one of the things we're looking at the moment. I mean, I think what you've got is sort of, for this year, you've been dogged by a number of risks, haven't you? You've had, the Chinese kind of semi-deliberate economic slowdown. You've had this, trade skirmish becoming real, Brexit negotiations trotting on, the Italy budget crisis, all these kind of things have stacked up and really kind of created this situation where now you've got sentiment which remains very depressed. If you look at most sentiment indicators, investor sentiment indicators, it's at reasonably extreme levels. And so what you've got going into the end of the year is the potential for some of these risks to fade. We suspect there'll be some form of compromise achievable on the Italian budget. We suspect it's more likely than not that you'll get a withdrawal agreement on Brexit. The trade war is still going to linger, but maybe you'll see a big handshake at the G20 that'll help markets further. And all of underneath that, the global economy still looks okay. The U.S. economy still looks safe to provide a pretty decent source of demand, particularly the U.S. consumer, to the world economy, particularly Asia. And so our sort of outlook is that, stock markets are you probably want to be leaning into emerging market and developed market stock markets into the end of the year.
Interesting, William, because many of those risks, the long list you just rattled off at the top there, are largely political risks. And you mentioned the strong economic fundamentals. Also, the corporate fundamentals have been holding up, especially coming from the U.S. We are getting ready for another big earnings story coming out of SocGen in just over 10 minutes' time now. I mean, what is your view overall on European banks, given the earnings we have so far and your expectations going forward?
Yeah, European banks have had a bit more of a mixed season. It's been mainly about cost delivery. Those are the ones that seem to have done well. There's not much in the way of revenue growth so far, but some of the sort of underlying trends in the economy are probably going to get a bit more helpful there. So Europe obviously has been struggling a little bit, particularly in Germany. The German car manufacturers have been struggling with the adoption of the new emissions testing standards. That's created this kind of little swoon in the economy for October and a little bit before that. That'll get better into the end of the year. That'll help. And underlying that, you've got decent loan growth still happening across the sector. Unemployment continues to come down. Asset quality continues to improve. And next year, you'll start to focus on when the ECB is going to start getting those base rates out of the basement. And that will all help the banking sector. And I think with the banks in general, investing in the banks, it's a matter of patience, really. They are cheap. There's no doubt about it. But you've just got to have the market start to recognize that, and it needs a bit more confidence that the ECB is going to be helpful and that the European project is not going to fall apart. We don't think the European project is going to fall apart, and we think the ECB will be a bit more helpful. So we are taking a sort of a small selected kind of high risk bet on European banks still.
And William, moving on from Europe, just to the UK specifically, Q3 GDP, what are your expectations there, particularly with what we're seeing or not seeing with a Brexit agreement?
Yeah, so Q3 GDP actually should come in okay because you should benefit from a rebound in consumption in evidence through the quarter. But within this, you should see investment continuing to be pretty weak. We've said before that while the global economy has been enjoying this increasingly noisy global economic party with investment picking up everywhere, the UK continues to have a bit of a sulky cigarette on the outside. However, the thing that we are seeing sort of from after this this Q3 is that you've seen a sharp decline in household and business sentiment signaled in October, suggesting a fairly bleak start to Q4. Like I say, the Brexit sort of negotiations are creating a bit of a shroud over this, and I think the reality of what a hard Brexit would look like, the sort of the economic chaos that could arise from a hard Brexit, is certainly deterring some decision makers within the economy. We suspect that it's more likely than not that will be resolved in time, and hopefully some of this economic weakness can subside.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.